Good morning, everybody. It is the day before St. Patrick's Day, which means time to pre-drink. No, just kidding. Kirk Spano, Investing 2020s. And today we are going to talk about debt, banks, and rising asset prices to pay the taxes, to pay the debt that the banks are going to fund. Yeah, lots of interesting stuff. So without further ado, let's take a look at, there we go, Forest for the Trees. This is from last week, and I think it's pretty important to go through because it hits on like 10 topics that I've been talking about. Now, they take the approach, the viewpoint, the Austrian economic viewpoint that everything is cyclical, that everything is relatively the same across the world, that there's not a lot of difference between nations, that economics, just economics. We have seen for decades, actually over a century, not entirely true. The United States is a unique shirt in the basket of dirty shirts. It is the cleanest dirty shirt. So when it comes to some of the things that they talk about happening in the future, probably not so, but some of their unrealistic, horrible outlooks aren't nearly as bad, I think, as the modern monetary theory side think, well, we can just keep printing money. There is an in-between. Like most things, there is balance to be found. We are not going to survive by just printing money and taking on debt, and we are not going to survive well if we cut back on spending and wipe out people's savings and don't support the population with the appropriate levels of spending. What we could do is the smart thing and roll back some of the tax cuts. I know, just a horrible idea. Roll back some of the tax cuts on the richest 1 or 2% of the population, leave everybody else alone, and then maybe, just maybe, as I have projected, we will run a balanced budget sometime in the 2030s as the maximum expenses for the baby boomers peak and then start to fall off. So what are they talking about at Forest for the Trees today, actually, last Saturday? Well, what have I told you is going to happen? Because it's already happened before. U.S. Treasury assets on bank balance sheets during COVID did not count when it came to having to mark to market the actual value and the calculation of capital requirements. So as interest rates went up, the banks saw their asset levels go down, and that messed up a lot of the banks. But what if they didn't have to make that adjustment? Well, in the past, they haven't because there is a crisis. Suddenly, not during a crisis period, but just right now, there's a letter written to the Federal Reserve and FDIC that basically says, hey, we need you to not count those certain assets as needing to be marked to market because it makes our balance sheets look worse. So here's what they say. To facilitate participation by banks in U.S. Treasury markets, which we've been talking about for 2 years now, including clearing U.S. Treasury security transactions for clients, the agency should revise the SLR to permanently, not just during crisis period, to permanently exclude on-balance sheet U.S. Treasuries from total leverage exposure. Consistent with the scope of the temporary exclusion for U.S. Treasuries the agencies implemented in 2020. You've heard me also talk about the Federal Reserve is paying interest on bank reserves. So the banks put money on the Federal Reserve's balance sheet, and the Federal Reserve in turn pays these banks interest on the money that they deposited with the Federal Reserve. Hasn't always been like that. It's been an on and off sort of thing. In this letter, they talk about maybe what we ought to do is, in the Forest for the Trees area, it talks about, well, if the Federal Reserve needs to make sure that the U.S. Treasury debt is covered so that the United States can continue to run deficits, which is going to push $3 trillion this year, half of which is interest on the debt. So think about that. How do you reduce interest on the debt? Pretty easy. You lower the interest rate. So we can get down to about $1 trillion to $1.5 trillion deficit if we brought the interest rate all the way back down to, under 2%. I don't see that coming because that would probably stimulate a lot of speculative spending, and you know what happens then? You get a bubble and then you get a crash. So they're looking for balance. But I think there's a very good possibility that they at least reduce the interest that they're paying to banks for money held on the Fed balance sheet. And if those banks want to get a little extra interest, they either have to loan it out or buy U.S. Treasuries. So that's what's coming. They're talking about it already. The rules are already in process. Jerome Powell the other day, and we talked about this once already, Jerome Powell basically said, these regulatory reforms from the Biden administration, we understand them. But after looking at over 300 comments from interested parties, mainly banks, we just don't think that in the form that's out there right now is going to work. We're going to have to revise a lot of it. In essence, making it easier on the banks. What did Kirk do this week that Kirk doesn't do? Kirk doesn't invest in banks. Why? Now, I will caveat that. I have invested in Wisconsin banks that I knew the story of. I knew what was behind them. I knew the assets. I knew that they were undervalued by, 70, 80%. It hasn't happened in a long time, over 15 years before the financial crisis. So close to 20 years. Well, I remember one of them was First Financial, and TCF eventually ended up buying something that bought that. Right now, I am investing in one bank, just one bank, that went through a lot of stress recently, just got $1 billion capital injection from private investors, which is going to be the model going forward, not government bailouts, but government support of private investors. We started to see that last year when the 3 banks collapsed. But Kirk doesn't invest in banks in general. Why do that when you could have bought Apple or Microsoft or Google the last 15 years? Even after the financial crisis, there was a little trade on the banks, but ever since then, they just kind of been chopping sideways, and they don't keep up with the S&P 500. They're very economically sensitive and quite manipulated. So unless you own a bank, like outright own a bank, which I'd be interested in doing, and I've brought that up with a private equity group, it's tough to be a bank investor. Unless you can get that bank dirt cheap with government support and brand new capital injected. And there is one community bank out there that just happened for. So if you take a look at the chat notes that Teresa so graciously put out again this week, you'll see the bank that I invested in. And I will have a whole article about it at some point. And I'll just put this out there. My job isn't to convince you by writing 3,000 words why you should invest somewhere. And that's why I've started to do the Kirk's takes, under 1,000 words, some pretty pictures, and really just say, look, here's the water. You can drink it. But don't expect me to regurgitate everything that's out there. This is where you go here, here, and here. You do that reading. And if you come to the same conclusions that I just showed you, or I just told you that I have, then go ahead and invest if it makes sense for you. But I'm not going to pound the table very often. When I do pound the table, you should take it seriously, because the times that I've pounded the table, we've done very well. So when I say I'm buying this community bank, I just pounded on the table, you should probably take it seriously. Now, the banking system is very important to the government, because they in the past have bought a lot of the U.S. Treasuries. Since COVID, there's been major hedge funds buying the U.S. Treasuries, and that's good. Always good to get more people involved in the market, good for liquidity. However, those hedge funds are very leveraged. Part of what these new regulations are going to do by not including, because it's coming, by not including the U.S. Treasuries in the capital requirement calculations, basically the mark-to-market, they are allowing these banks to take a lot of leverage. So the hedge funds are taking a lot of leverage to support the U.S. Treasury market, and now the banks are going to be allowed to take more leverage because the U.S. Treasury market needs it. Now, at some point, the United States has to run very close to a balanced budget. Again, it doesn't have to be balanced, but it has to be close, within 2%, because that's the rate of inflation you're looking for. But since there's inflationary pressure right now, which, again, is short-term, it's cyclical, but because the government just keeps on spending more than it has, that ratio has to get closer. I'm going to show you something in a couple minutes. I'm going to show you some alligator jaws, and then you're going to think, okay, how will that resolve itself? How will these alligator jaws resolve themselves? Because you'll see on the chart that I show you, there wasn't alligator jaws before, but now there is. So if we go down through Forest for the Trees and find this other chart right here, we can see global central bank foreign reserves stopped growing in 2014, mainly China. But US Treasury debt just kept going up. So if there's not going to be more foreign investment in sovereign debt, US sovereign debt in particular, what starts happening? This line can't go up infinitely because there just won't be enough banks or US investors or foreign investors to buy all that debt. It just becomes a mathematical equation. So two things do necessarily have to happen. One, it'd be nice if this ticked up a little bit. And two, this necessarily has to flatten out. And that can happen with lower interest rates and maybe we let some of those tax cuts expire for the super richest people. They don't need them. You can give them different tax breaks for like actually investing in new housing or alternative energy, all sorts of things. And the alternative energy is fairly important because the United States is starting to run up against some constraints for electricity, which is why when I finally build my house in the next couple of years, I am definitely pitching that roof towards the southern sky so that I can get solar energy. And by then, the solar panels will be even cheaper. So we know that this has to flatten out. So U.S. debts have to flatten out. And it doesn't mean that we have to run a surplus. It doesn't even mean that we have to be completely balanced. It just means that this has to flatten out so that over about a 30-year period, we gradually, which happens to coincide with the baby boomer generation reaching its expiration, we have to gradually pay off the debts just as they come due. So that when the millennials start to retire, we've kind of reset things, but we don't have to worry about their retirement. Now, what would make this blue line go up? Well, I just told you, this is when China stopped expanding foreign reserves. We would need China to start to buy more foreign reserves. So what is the thing going on with China right now that we all know? We know that China's excess savings are starting to become a danger to the rest of the world. Why would savings be a danger? Because they're not investing them anywhere and they're not spending them. It's money that is like the dragon's gold layer. It's just not doing anything other than being guarded by a dragon, which is kind of funny because it's China. So we take a look at this and we say, okay, China has all this money being saved. What can we expect to happen? There you go. They're saving almost half of their money, over 45% of the money that they earn they don't spend. And it gets invested in some of those really stupid investments that they lose money on. If somehow the Chinese could be convinced to spend some more of their money and diversify it globally, that would be good for everybody, in particular the United States. Now, over the last few months, and I talked about this when it first happened, that meeting in San Francisco between Biden and Xi and a bunch of the bank people, the federal bank people, that something's going on. And I said way back when Joe Biden got elected that first year, I said, at some point he's going to have to cut a deal with the Chinese. And they've been working on that for the last few months. I don't know really how that shakes out. Maybe Xi just says, screw off, let's go hardcore and see what bad things can happen. But I suspect that the deal that's coming, because of the way that the words have been parsed, is that Taiwan is going to become a Switzerland-like place. It's what should have happened in Ukraine 15, 20 years ago. But Russia just kept trying to steal it. And the United States and Europe weren't very good. When they had their window for like 2 years to do something smart with Ukraine in 2011, 12, 13, I guess, they didn't do it. And then Crimea happened. What could have happened in Ukraine is before the Russians invaded Crimea, before Putin, evil dictator bastard that he is, that you should really hate and never vote for anybody that supports him, they should have preempted him and said, look, how about this? We're going to let Ukraine be part of the European Union, but not NATO. And we're going to arm them, but we're not going to promise to defend them, right? Because we need to make money selling them weapons. And we'll allow Ukraine to become a trade partner with both you and the West. Instead, everybody fought, and now we got this horrific war, and the Ukrainians are suffering, and the Russians are suffering. I mean, the richest Russians are getting super rich, but you've got a couple 100,000 dead Russians, which basically bought that money in blood. And at some point, bad things happen, and probably the $300 billion that's frozen gets seized. which probably doesn't lead to good things. In any case, in Taiwan, we can avoid that conflict if we tell China, look, how about this? You'll have a special relationship with Taiwan forever. We have to create a new definition. It's kind of like creating a new investment category. If you create a new investment category, you win that category. Why? Because you invented it and nobody else is in. So they can create a new investment category, aka Taiwan, by making Taiwan independent, but in a special relationship with China that allows exports of Chinese goods with a Taiwan stamp on it. Probably doesn't even have to land in Taiwan. I mean, they could, I guess, to, functionally touch it. But all those things that we're putting tariffs on right now that we actually need, like solar panels, we could run the trade through Taiwan's special relationship with China, and everybody wins. Taiwan doesn't get taken over. We don't have to have a war in the Pacific. China makes money. They can keep their industrial machine going. We predicate it on some sort of investment in U.S. Treasuries again. They could write a rule that says, look, Chinese banks have to have so much foreign currency and bonds on their balance sheets to get special treatment from, Bank of China. So everything can be solved through rules making and the levels of taxation and tariffs and things like that if we want to, if cooler heads prevail. So all this money just sitting there doing nothing is available to the world, and really the United States is trying to get our hands on it again because we have that other problem with the alligator jaws that I just showed you. One of the reasons that interest rates haven't come down yet is that inflation is still persistent. However, Milton Friedman said inflation is everywhere and always a monetary event. And I have argued since I was in college that's not entirely true, because at some point, the fiscal policies of a country can cause inflation, overspending, overinvestment, running up big debts that you have to try to inflate away because you can't pay them off. And the United States isn't quite there yet, but everybody is talking about it because we can tell that the problem is not 30 or 40 or 50 years away anymore, which we rationalized away in the 80s and 90s and 2000s. Rather, the problem of not ever running a balanced budget, right? We haven't run one in 25 years, is starting to cause permanent inflationary pressures up against the other deflationary pressures. And when you squish inflation up against deflation, you get stagflation, and that would be horrible. So the United States needs a couple of things. One, we need to flatten out the debt accumulation to be very, very minor. We can do that by reducing the tax cuts to the wealthiest people, or at least changing the nature of how they can earn them, right? Housing is the biggest component in inflation, and we need millions of more houses. In Wisconsin, we're something like 50 to 60,000 houses short, just Wisconsin. Nationally, it's a much bigger number. I thought it was like 3.5 million or 4.5 million. It's in the millions. So if we can somehow tie tax breaks rather than just, we're going to give you tax breaks and see what you do with it, tie the tax breaks directly to specific items that we need. Maybe companies that finance medical education get a special tax break. Maybe companies that invest in new housing get a special tax break, rather than just blanket capital gains and carried interest tax breaks that really are applied to market-based investing, skimming the system, the big skim. Take away Ken motherfucker Griffin's tax breaks for carried interest and capital gains for skimming the markets by front running using technology that you and I don't have. Let him talk about providing liquidity and, all the other bullshit that he tells you, and say, look, how about this? Let's get rid of those kinds of tax breaks that really don't help anybody, except a couple people get super rich, and say, look, how about if you build houses, then you get a capital gains tax break, right? Or if you help us with the shortage of nurses, engineers, and teachers by offering to pay off student loan debt, you get a tax break. Things like that. There are much smarter ways to give tax breaks than just blanket stuff that really goes to financial people. That's where a lot of it goes. And thank you very much. However, probably not good policy. So when you hear President Biden talking about closing loopholes, that's great. That's actually the right track. But then when you hear him talk about, well, I want to give everybody $400 a month. Jesus Christ, Joe, you were halfway there. But then on the other hand, you got Trump, who basically wrote a tax code so he could skim the system and some of his buddies could. You're like, well, that's horrible. We know that the Trump and Bush tax cuts account for about 80 to 85% of the U.S. debt in the last 22 years. Those studies are out there, not even in dispute. And those tax cuts did not pay for themselves. Not even close, actually. They could talk about it. Oh, we do tax cuts. They'll just pay for themselves. Well, it turns out that was bullshit. Just like it was bullshit when Reagan did it. Reagan did tax cuts and higher spending. Kind of became a thing. It's been the trend. It's been the fashion. We need to direct things. They're starting to talk about what I've been talking about. Why? Because smart things eventually happen. That's why I'm always optimistic. Because even though we screw things up on a pretty much perpetual basis, we get around to, as Winston Churchill pointed out, we get around to doing the right thing. But we like to have a crisis first. We don't really like to plan 10 years ahead, much less 20 or 30. That's why so many Americans don't save for retirement. Well, if I only put the match into my 401k and save 3% a year because they're matching 3% a year, hey, I'll do that. But I'm not going to round it up to 5 or 10% because then I can't go out and have as many beers. Anyway, it's that lack of looking forward that kills people as investors, as savers, and then it just spirals into, well, my life isn't as good as I want. And then people just spiral down the tube in their attitude and their approach to life. They pass it on to the kids, and it's horrible. Speaking of kids, by the way, the reason I'm wearing my hat today is because I went to see Newsies at a local high school, and they did a really good job. So to all the kids at Franklin High School in Wisconsin, great job on Newsies, blew me away. I couldn't believe it when he came out and tap danced. I was really pretty surprised that I was that happy on a Friday night at a high school play. So good job. In any case, I think that it's important as investors that we start thinking about, okay, what are the chain events that we're going to see? And I'm not going to go through the entire article here, but it is a good one. So I'm going to post this in the chat if it'll fit. I'll have to shrink down the PDF. If not, I'll stick it in an article and pretend that I was commenting on it. Or maybe I will comment on it. But it is pretty important to consider the linkage that they do in this particular article, because it kind of hits all the things that I've been talking about. They talked about how Apple is having a hard time because in China, right? Yeah, the government stopped using their phones and they've been getting undercut on price. So it's been hard for them to keep up in China because really the technology on all the smartphones is pretty close. And if you're not really tied into the Apple infrastructure, it's easy to leave. I've told you, I might go to Google Pixel at some point just to be consistent with what Jolene has because she likes that. I really like Apple. I do. Makes my life easy. I know the system. I'm getting resistant to change as I get older. I don't want to learn a new telephone system, but maybe I'll do it just to force myself to do something different. We'll see. The point on Apple is that while they're a fortress, they need to start doing other things, which is why I think they might get involved with Paramount or Warner Discovery or something. They have to get more into entertainment and other things that can generate revenue for them besides just making Siri smarter, because she really is kind of dumb. A lot of people have talked about commodity super cycles. Well, not going to be a super cycle, but the way that commodities have always worked is commodity production ends up being short for what our needs are on the industrial side. So they invest in commodity expansion, right? And then all of a sudden, because commodity, you end up having plenty of it. And so the beneficiary goes from the money flowing into the commodity companies. Everybody goes, oh, look, this company's going to make money forever. And then the price of the commodity comes down. And as the price of the commodity comes down, who does well? The industry using the commodity. So for the next couple of years, you're going to see some of the commodity producers, which have just gotten decimated the last couple of years, go on an upcycle. So I've added a company back to the very short list that I took off a couple of years ago when they peaked. And we started to see, oh, this is going to take longer. And, they're not going to really get everything running until about 2025, 26. It was MP Materials. So we bought it cheap. We doubled or tripled our money on it, depending on who you are and when you bought and when you sold. And then I took it off the list. I said, hey, this is maybe something that comes back in the future. Well, I put it back on the list. I'm not sure if I really want to buy it just yet, but it's definitely worth watching. Also talked about a lithium producer. And this is a company that actually bought a different lithium producer that we had invested in. So I'm super familiar with their assets. And suddenly the government's about to give them money. What do we like about companies that get government money? They're getting government money. It's free money. So for the next 1 or 2 years, you're probably going to see some of these commodity producers in copper, in lithium, in rare earth metals do pretty well. But then as production ramps up, as the price of those things come back down after they go up, they go on their waves. The industries that use those commodities do better. What other companies are going to do better? The companies that use AI. So companies that produce AI right now are getting all the hype, but really industry that uses AI and benefits from cheap commodities, they're really going to do well because they put a margin on all those widgets that they sell. Now, the software companies that help those companies run, they'll do well too, because that's just recurring revenue. And then as their CapEx comes down, their revenues go up and their profits expand. So you have to think of how these capital cycles work. And what we can see is that the interplay between the governments, the central banks, and industry at multiple levels, from commodity production to using commodities to creating AI to using AI, there is a way to look at all these sine waves on a chart and understand what that's trying to tell you. It's not just a confused, jumbled mess. So what we're probably going to see are very specific things that do very well. One of the things that will continue to do well is Bitcoin relative to gold. There's actually a pretty nifty chart that he put in here that I will show you. So when you divide one asset by another, you get a ratio. One of the things that's been happening is that people have been selling TLT to buy S&P 500. Ratio goes up. Eventually comes down, correct? And we'll talk a little bit about TLT when Shooter gets on. Gold, selling TLT to buy gold, selling TLT to buy industrials, selling TLT to buy Bitcoin. Oh my God, that's straight up. So there will be corrections in all these. But if we know that the trend, and remember the Federal Reserve is saying the neutral rate's 2.5%. If we know that interest rates have to come down to support, one, housing, but two, support U.S. Treasuries from creating a debt that we can't repay, we can basically surmise that as money comes out of U.S. Treasuries from individual investors to go into other assets, but then the banks fill that hole and maybe foreign investors fill that hole, you can create a virtuous cycle rather than a doom loop. And the virtuous cycle is, I think, the smart thing to bet on, because if we get the doom loop, I'll see it coming because I've seen all the other crashes coming, and we'll get the hell out of the way. What could create the doom loop? Well, I know this touches on politics and some people will hate this, but I'm just telling you, if Trump gets elected and he in particular gets a Congress that will pass some of his stupid bills, it'll create a spike and then probably another financial crisis, maybe worse, because the numbers are bigger now. We already know that they're adding leverage to the Treasury market, which is dangerous in and of itself. We know that private credit spiked and everybody's piling into these BDCs. I'm just telling you right now, all these people investing in BDCs, they don't understand what they're investing in. They're chasing yield and they're going to lose 30, 40, 50% of their money the next time there's a recession. They're going to get destroyed. You know who won't get destroyed? People who are the executives of those companies, because they just take bonuses in cash and they sell their shares on a pre-planned basis because I got financial planning to do. Bullshit. They know what's coming. So if you're loaded up on BDCs, I'll just warn you right now, you can love your 8% dividend yield right now, but when that drops 50% and you'll still get your 8% because they'll cut the dividend, but because the price drops so far, it'll still be 8%. You're going to be going, well, they screwed me. They're screwing you now. They're sucking you in. You're the sucker at the table. If you don't know who the sucker at the table is, right? Anybody plays poker, you know this saying, if you don't know who the sucker at the table is, it's you. And that's what's happened with BDCs. And I'm going to start writing about how there are so few BDCs out there that are worth their weight. There's one that I like. There's probably 2 or 3 that I'm okay with. But the risk in BDCs, private credit, and other things like that, there's big trouble coming. I don't know if it takes 2 or 3 years or 4 years for that trouble to play out. But when it comes, it'll be part of this next correction that we get. And the next correction we get will either be a run-of-the-mill recession that we can deal with in a year or two, or it's going to be a hyper financial crisis that gives us the 5, 6, 7, 8 years of being totally screwed that we're all afraid of. And I'm just telling you, one set of politicians is way more likely to have that happen than another set of politicians. And you can say, but I don't vote on that stuff. I vote on this. I vote on that. I vote on social issues. I vote on the border. Okay, you do you. But I'm just telling you, from a financial standpoint, you may want to work at a local level on that stuff and not elect people who are just trying to steal all the money from the country. You do you. All right. They also go on to talk about energy. This is why the price of commodities goes down, by the way. If you don't have one giant buyer at the margin buying everything up, then prices go down. So commodity users probably do pretty well. Oh, by the way, they mentioned this, which I thought was super interesting, because we have a company that happens to own a refinery in India that's debt-free and expanding on free cash flow. This is what India spends their money on. So anybody that doesn't quite get why I'm invested in Ametis, here, just take a look at this. This is what India spends their money on. I'm invested in a refinery company that produces biofuels in India. It's debt-free. It's expanding out of its own free cash flow, and it's going to get monetized sometime this year when they partially IPO it. I don't really know how much forward-looking I can be for you than say, understand this is what India spends their money on. All right. And the final point I wanted to make is that gold is not going to do better than Bitcoin. Oh, wait, that wasn't my last point. My last point is this one. In the last few months, I've told you that it looks like we're getting the last opportunity to buy solar stocks right now. And people like the battery stocks too, but the problem with the battery stocks is that technology changes so fast that we don't really know who the leaders will be in 3 years. I suspect that one of our companies is going to license out their technology for EV batteries rather than producing them themselves. That'd be the smart thing to do. So if they do that, then I'll be very happy with that company. If they try to build another factory to build EV batteries, I'll be very sad with that company. It'd be a bad capital allocation decision. There's already plenty of factories in the works where if they just swap out one technology for the other, it'd be a smart thing for everybody. Introduce more competition, that's bad for pricing. So we'll see if this battery company that we're in takes their battery, which is about 30% better than existing batteries, and says, hey, here's the patents, we'll make them available to you, and you can tweak them using your materials or your technology too, and we just want our cut, and then they never have to build a factory and spend all that money. We'll see. In any case, the United States is starting to bump up to electricity constraints, and people are going to blame Bitcoin mining for the fraction of a percent of the energy they use. And they're going to blame AI because, oh my God, AI is using a lot of energy with the, AI is using way more energy than Bitcoin miners. Everybody's going to blame. Oh, we should just keep burning fuels because, we don't have the electricity. Look, those are all dumb arguments. The smart argument is, hey, why don't we just keep incentivizing slapping solar panels on things and continue to upgrade the grid and continue to upgrade buildings? Provides economic development, saves the climate, gives us a more reliable energy grid and energy system, energy security. Anybody? So that's what's coming there. You're going to see a lot more solar development. You're going to see a lot more grid development, and you're going to see batteries become commoditized eventually, but there should be a big rally first. And then as the price of the batteries comes down in 6, 7, 8 years, then it goes the other way. But there's a pretty big rally coming in all things electricity. I'd say through early next decade, maybe middle of the next decade. It's going to last a while because the transition doesn't happen overnight. But understand the capital cycles and understand that as things become abundant, they become cheap, which is why I'm not all that excited about most commodities other than play the hype cycle a little bit, because we know, we know that we're going to have plenty of commodities in the future, because just mining one asteroid, mining one asteroid is going to provide us with almost everything that we need, right? It's like having another planet to mine and we don't have to worry about it getting polluted. We just got to figure out how to drop the stuff from up there to down here. And they'll figure it out. They always do. By the way, did you see the rockets that got launched this week? Lots of rockets got launched this week. Rockets Labs, SpaceX, some other company, So lots going on in the world. And can we screw it up for a decade? We can. Been known to do it. However, I do think that smarter heads will prevail. If nothing else, Xi wants to preserve his power, so he can't let his country go through a financial crisis. U.S. politicians, particularly in Congress, because we're too dumb to put term limits on them. They want to preserve their power, mainly because they steal. But a handful of them want to just keep doing the right thing, mainly because they steal. So we'll see some smart decisions get made, although the wrong politicians go in, they just take the bribe and, help other people steal. So we'll see how it goes. I believe, that I would like to buy the Milwaukee Brewers, so I need a couple $1 billion to do it. And I'm, a couple billion short. So at this point, for me to make that kind of money, I would need a horrific crash. Not only that drove the price of the Brewers down, but that I could bet on with leverage. And while everybody else is getting blown up, I can big short them and become a billionaire. I'm telling you, my only chance to buy the Brewers is if Trump gets elected and creates that crash for me, the spike in the crash that I would need for that to happen. We'll see. So if Trump wins, you can congratulate me on becoming the Brewers owner in about 10 years. Trump loses, then I will just be a content multimillionaire. We'll see how it goes. All right. Have a good week. I'm going to put this article out. I've actually started to do PowerPoints again to make pretty pictures, and we will go from there with a new macro dashes coming out, which basically is the working title is Chairman Powell's Angst, because I said there'd be angst this year. And a week or two ago, I said that the correction starts on March 20th. I'm sticking with that. I will be on Wolf Financial a couple times on their X rooms or X spaces or whatever they're called. So if you want to take a look at my Twitter feed, I have been starting to be on Wolf Financial again, and I will probably do it every week. So if you want to get into the Twitter stuff, there's a chance that Musk doesn't destroy that company. We'll see. In the meantime, jump on in. All right. I will have Shooter ready to go in just a minute.